Okay, so hello and welcome to today's session. Now, let me just brief you all regarding the things we need to follow in this particular session. First of all, my name is Ahmed Shafi, and I am your tutor of this AFM webinar. Now, obviously, this class is being conducted as an online class, and in online class, there is always a dependency on network, internet for me as well as you. So sometimes the past history is that there has been some issues during the class that sometimes the other people networks go off and they constantly message in the chat box that we are unable to hear anything, even though the problem is at their fault, but they don't realize. Similarly, sometimes there is a network problem at my end and I suddenly get disconnected and you all are just sitting in front of the screen that now what should we do? Will the class resume? Will it resume after 10 minutes or 15 minutes or 30 minutes? Okay. So to overcome these problems, what we do is that we immediately create a WhatsApp group. Okay. And on that WhatsApp group, we basically gather everyone so that in case there are any discrepancies with respect to network in between, so I can always communicate with you. Plus, the group is also made that later on, if you have any discussions you want to do with each other, you can always do via that WhatsApp group. Okay. So in your chats, I have shared the WhatsApp group link. If you want, I can share again. In the chats, I'm just giving you 2-3 minutes before starting the class that please join this WhatsApp group, because in between, if there is going to be any problems, we will be coordinating via this group. Okay. So just last 2-3 minutes, everyone joins and then we can start. Okay, so once again, a last message that whoever is in this meeting, please join this WhatsApp group so that we can communicate later on that. And I also share some more videos on that WhatsApp group. And even after this class, the recording of this session will be shared in the group as well. Okay, so let's start. Now, in every webinar session, our main objective is doing a past paper question. Okay. We do a past paper question, and obviously before the exam, when students do past exam questions, it really helps them. Okay, so I will be doing a past paper question on the ACCA examination past paper and on the practice platform. Okay, so in today's session, we will be doing a past paper question. You all have idea that there is a practice platform on the ACCA website. So we will be doing questions from there. Okay. Now, you all need to, obviously, when you will practice, I would suggest you that when you do examination questions, it's better to do questions on practice platform. So you can always log into the practice platform. And when you log in, it asks for your user ID and password. You enter it, ACC ID and password. You get to the login page. Okay. And on this login page, you have all the past exam questions at the right side. So I go in advanced financial management, ACC official resources, past exam library. There are multiple past papers. And today we are going to do a question on this March-June 2022 attempt. Okay. You can assign it. And once you assign it, it goes here. So March-June 2022, and you click on that paper, you get it. So it gives you the instructions and you click on next. So this is question number 1. Then it goes to section B, question number 2, and then it goes to question number 3. So from the March-June 2022 attempt, we are going to do this question. And as I told you that this question is from March-June 2022 attempt, I will be solving this question with you in today's session. Okay. So let's start doing this question. Okay, so as is mentioned, the following exhibits available on the left-hand side of the screen provide information relevant to the question: introduction, sale of coffee shop, CC statement of financial information, and other information. This information should be used to answer the question requirements within your chosen response options. Okay, so there are 4 exhibits and we will do these 4. The first exhibit is introduction. Okay, let's see what is in the box for us. The question states that CHARBOROUGH company was established 20 years ago, offering high quality coffee at a reasonable price. So the important thing is that CHARBOROUGH was established 20 years ago, and it is offering high quality coffee at reasonable price. As well as offering takeaway coffees, CC marketed its coffee shops as being comfortable places. I forgot to add one thing. I won't be looking at the chat box during the class. Okay, so if you want to communicate everything with me, you need to use this WhatsApp group. Okay, which I have just made. Okay, so I won't be looking at the chats, so don't message on Zoom chats. Whatever message you have, please message me on this group. Okay, because it's difficult to look at 2 places. Okay, so let's start this question. The question states CHARBOROUGH company was established 20 years ago, offering high quality coffee at reasonable price. Okay, as well as offering takeaway coffees, CC marketing its coffee shops as being comfortable places in which to spend time and which meet friends. Okay, for most of its life, CC's coffee shops have outperformed its competitors, and CC was able to obtain a listing 6 years ago. Now, from the opening paragraph, it is clearly evident that the coffee shops is successful. Okay, because it states that CHARBOROUGH was established 20 years ago, offering high quality coffee at reasonable prices, as well as offering takeaway coffees. They are offering takeaway coffees. CC marketed its coffee shops as being comfortable places. The coffee shops are being marketed as comfortable places in which you can spend time, meet friends. For most of its life, CC's coffee shops have outperformed its competitors. Okay, and CC was able to obtain a listing 6 years ago. Most of the funds obtained from the listing were used to buy a struggling fast food chain and rebrand it as a fruit juice bar chain. The fruit juice bar chain and coffee shops are now separate divisions within CC. Now, For most of its life, CC's coffee shops have outperformed its competitors. CC was able to obtain a listing 6 years ago. So you obtained a listing 6 years ago. That means you went on the stock exchange. Okay. And when you went on a stock exchange, people purchase your shares, you get cash. So the second paragraph states, most of the funds obtained from the listing. Obviously, when you listed, you got funds via stock market listing. So most of the funds were used to buy a struggling fast food chain. What did you do from those funds? You bought a fast food chain that was struggling, and you rebranded it as a fruit juice bar chain. You rebranded it as a fruit juice bar chain. The fruit juice bar chain, number one, because you bought the fruit juice bar chain, and coffee shops are now two divisions. Okay. Third para, the fruit juice bars offer a mix of drinks and salads with flavors from around the world, the appearance of the bars reflecting its global influences. So fruit juice bars offer a mix of drinks and salads. So you are being offered a mix of drinks and salads with flavors from around the world. This is what you're talking about, fruit juice bars, mix of drinks and salads. The chain has been successful in terms of attracting fashionable young customers, but has required significant investment. So the chain was successful in terms of attracting fashionable young customers. Obviously, it's a juice chain, drinks chain, salad chain. So it has been successful in establishing and attracting customers, but has required considerable investment. It is eating your money, investment. Up until recently, much of its investment has come from surpluses generated by CC's coffee shops. So this fruit juice bar chain is requiring investment. Where are the funds coming from? So the funds are coming from the surpluses generated from coffee shops. The coffee shop generates surplus and they reinvested in fruit juice bar chain. Okay. However, the growth in profits of the coffee shops has slowed in the last 2 years. Now, this is where the problem is starting. Your fruit juice bar chain requires investment. Okay. And from where this investment is coming from the surpluses generated by the coffee shops, because it was successful. But the growth in profits of coffee shops has slowed in the last 2 years. In the last 2 years, the growth in coffee shops has slowed. So where are you getting the funds from, right? No. Customer and media comment has suggested that CC's coffee shops now need significant refurbishment expenditure. So customer and media comments say now you need significant refurbishment. Competition in the coffee shop sector has led to some mergers between rival chains. So competition in the coffee shop sector has led to some mergers between rival chains. CC has just received an inquiry from a competitor about whether it would be interested in selling its coffee shop. So now the things have gone so out that someone has approached a CC coffee shop that whether you would be interested in selling coffee shops, not the juice brands, coffee shops. CC's board is likely to accept a reasonable offer for its coffee shop. So the board is likely to accept this offer, reasonable offer, as it believes the juice bars offer more prospects for future growth. Just wait for 2 minutes. It's azan going on, the religious prayer. Okay, so let's just quickly do a quick recap. The first paragraph stated that Charborough was established 20 years ago, offering high quality coffee, and it was a good venture, outperformed competitors, and CC obtained a listing. Now, from the listing, they got money. Second paragraph states you bought a struggling fast food chain and you rebranded it as a fruit juice bar chain. Okay, fruit juice and coffee are separate divisions. The fruit juice bars offer a drinks and salads. It has attracted customers, but it requires investment, and investment has come from the surplus generated from coffee. Okay, but now the growth has slowed down. Competition has led to some mergers. CC just received an inquiry from a competitor that they wanted to acquire CC, and CC's board is likely to accept the offer. Okay, as it believes juice bars offer more prospects in future growth and profits. A large cash inflow from the sale of coffee shops would fund further expansion of the juice bars and refurbishment and upgrading of existing juice bars over the next few years. Now, a competitor is approached that sell your coffee shops. Obviously, when you sell, the board is interested in accepting this offer. You get cash. So what will you do with that cash? You would do expansion of juice bars, refurbish existing juice bars because you think they offer more growth prospects. However, one of CC's non-executive directors has suggested an alternative arrangement. Under this arrangement, the coffee shops would be run by a separate company. CC would hold a majority of shares in this company, but offer a minority of shares on the stock market. But there is one NED who thinks that you should give it for running to a separate company, but you should hold major shares, minority shares on the stock market. Okay, this is the introduction. Okay, so what did we learn from the introduction? This is what you should do in the exam. Quickly recap what you learned. In the first paragraph, you learned that coffee shops are successful. They went on listing. Second paragraph, when you got the funds from listing, you bought a struggling fast food chain, rebranded it as a fruit juice bar chain. Third paragraph, fruit juice bar chains is attracting customers, but requiring investment, and investment coming not from there, but from the surplus generated from coffee shops division. Fourth, now you received an offer to sell coffee shops. You think your board thinks you should sell them and get the cash and rebrand and expand your juice bars. And finally, one NED suggested that keep majority shares, sell minority shares. Okay, this was the introduction. Now, second. You were willing to sell the coffee shops, right? So the second exhibit says the sale price of the coffee shops will be the sum of present values of predicted future free cash flows. You're selling the coffee shop division, right? So what should be the sale price? It's saying that the sale price of the coffee shop should be the sum of present values of future free cash flows. Okay, fine, fair enough. The sale price will be the sum of present value of predicted future free cash flows. The predicted after-tax profits of the coffee shops are. So what are the after-tax predicted profits of coffee shops? Year 1, 2, 3, 4, 296, 328, 360, 388. This is the after-tax profits of coffee shops. The after-tax profits of coffee shops, including the profits of the coffee shops, can be assumed to be 658 million in year 1 if the coffee shops are not sold. Okay, these are the after-tax profits of the coffee shops. Above, year 1, 2, 3, 4. I think it's if they are sold, this will be the predicted after-tax coffee shops profits. How did I know this is the profits after they are sold? Because it states in the paragraph, the after-tax profits of CC, including coffee shops, can be assumed to be 658 million in year 1 if the coffee shops are not sold. If you don't sell them, it's 658. But then if you're selling them, these are the profits. These amounts can be assumed to be equal to after-tax cash flows. You can assume these are the same as after-tax cash flows. Capital investment in the coffee shops can be assumed to be 60 million in year 1. In the second to fourth year, capital investment will increase by 0.5 per dollar one increase in after-tax profits. Okay, so this is the capital investment. 60 million year 1, and second to fourth year, it will increase by 0.5 per dollar one increase. Third, after year 4, free cash flows for the coffee shop should be assumed to increase at 3.5% per year for the foreseeable future. So the data was given till year 4. What will happen after year 4? The free cash flows would be increasing at 3.5% per year for the foreseeable future. That's 5 to infinity, right? Because after year 4, it's year 5. So from year 5 to infinity, they will grow at 3.5% per year. The discount rate should be used to be the current weighted average cost of capital, which is 10%. You should use weighted average cost of capital 10%. Okay. Now the third CC's current statement of financial position, including fruit juice bars and coffee shops. So this is the company's balance sheet, statement of financial position, including juice bars and coffee shops. You are given the whole balance sheet, assets, non-current, current, total assets, equity liabilities, call up share capital, retained earnings, equity, non-current liabilities, bank loan, etc., etc. Okay. This is the third one. Fourth, other information. What does the other information say? The proceeds received from selling the coffee shops would be used to first pay off the 9% loan notes. You just saw in the balance sheet, there were loan notes. So the proceeds received from selling the coffee shops, when you sell the coffee shops, you receive sales. They would be used to pay off the 9% loan notes. The remaining amount would be invested in enhancement expenditure on the non-current assets of the juice bars. Whatever amount you receive, it will be used to pay off the 9% loan notes, and the remaining would be investment in enhancement expenditure on non-current assets. So the remaining amount you will invest in non-current assets. The investment in the non-current assets in the juice bars would expect to earn a 17% pre-tax return. Obviously, you are investing some amount in investment in non-current assets. So what will happen when you will invest? This investment in non-current assets would give a 17% pre-tax return. Okay. Second point. The current net book value of the non-current assets of the coffee shop can be assumed to be 3350 million. So current net book value of non-current assets can be assumed to be 3350 million. Okay, so book value of non-current assets will be 3350 million. This is the current net book value. Okay, the profit on the sale of coffee shops will be taken directly to retained earnings. Whatever profit you get from the sale of coffee shops would be taken directly to retained earnings. The figures for current assets and current liabilities can be assumed to remain same when the coffee shops are sold. When you sell the coffee shops, you assume that current assets, current liabilities remain same. Fourth, the overall pre-tax cost of debt is currently 8%. Your KD, cost of debt, is 8%, and it can be assumed to fall to 7% when the 9% loan notes are redeemed. Obviously, when you will redeem loan notes, it will fall to 7%. This is cost of debt. CC currently has $500 million $1 shares in issue. They are currently trading at $8 per share. This is expected to rise by 5% as a result of sale of coffee shops and the improved prospects for juice bars. You have 500 million shares. $1 is the par value. They are trading at 8 per share, and this will rise by 5% when you sell the coffee shops. Asset beta for the juice bars can be assumed to be 0.7. Taxes payable at an annual rate of 25% on profits. Risk-free rate is 4%, and market return is 11%. Okay, these are the four things mentioned in exhibits. Introduction, we read the introduction. Sale of coffee shops. Okay, balance sheet was given, and then this other information was given. Okay, so after all this stuff, what is the requirement? It's a 25-mark question and has 4 requirements. Requirement 1, A1, sorry. Calculate the expected sale price of the coffee shops. So you need to find the sale price of the coffee shops. Requirement A2, calculate the impact of the sale of coffee shops on CC's forecast statement of financial position, forecast earning per share, and weighted average cost of capital. Part B, evaluate the arguments for and against the decision to sell the coffee shops. Okay, you need to evaluate the argument for and against the decision. It's a very, very easy requirement that what are the arguments for sale and against sale, advantages, disadvantages. Okay. And 5-mark requirement, discuss the advantages and disadvantages of the suggestion made by non-executive director. Okay. It's a 25-mark question. And like you can see in all questions, 13 marks belong to calculation. 4 marks and 9 marks belong to calculation. 50-55% to calculation. The remaining 50-55% for discussion. People say that for discussion, what should we do? Seriously, you cannot do anything for theory except running your mind, using your mind. Okay, if you even go and eat and memorize the whole study text, there is nothing mentioned in the study text. What are the arguments for and against the decision to sell the coffee shop? You won't find anything. Okay, so in my opinion, book reading sometimes is a waste of time. Okay. Secondly, you say, okay, I will read all the past paper answers. Even if you go and read all the examiner answers, you are never ever going to find this answer for and against the decision to sell the coffee shops. It's created from this question. So you need to read this question carefully and then use your mind. What are the arguments in favor of selling? Write 3 or 4, 1 mark per point, so 3 or 4. And what are the arguments against this decision? 2 or 3. So 3, 3, 6 marks is fine. Okay. And part C, discuss the advantages and disadvantages of the suggestion made by NED. Remember, NED made a suggestion, 5 marks. Write 2, 3 advantages, 2, 3 disadvantages. So unless you are able to use your mind, this is what happened in professional papers. People say, oh, sir, what should we do for theory? It's not a memorizing paper. You should realize this fact that you are now in a professional paper. These are one of the last few papers of ACCA. So how can you just rely on memorizing anything going? You have to work out your mind. Okay. Anyways, let's start this. Firstly, it's the requirement A1, calculate the expected sale price of the coffee shops. Okay, now we are resuming with the requirement. Requirement A1 is calculate the expected sale price of the coffee shops. Okay, requirement A1, expected sale price of the coffee shop. Now, if you talk about the expected sale price of the coffee shop, okay, when you talk about expected sale price of the coffee shop, always remember the expected sale price of the coffee shop. The information is mentioned in the question. Okay. Remember this exhibit number 2. See, the sale price of the coffee shops will be the sum of present value of predicted future free cash flows. Okay. The sale price of the coffee shop will be the sum of present value of predicted future free cash flows. So I got my answer. The sale price of the coffee shop will be the sum of present value of predicted future free cash flows. So I just need to find the present value of predicted future free cash flows. And once I'm able to get the present value of predicted future free cash flows, I get my answer. Okay. So let's just go through this, that the sale price will be the sum of present value of future free cash flows. Okay. Now, those students who have studied from me, they know that we need to find the sum of present value of future free cash flows. How do we get the future free cash flows? If you remember, how do we get the future free cash flows? This is my notes file, which I shared with those students who are studying from me. You might be familiar with this notes file of mine. Okay. So in this notes file, you need to find the present value of future free cash flow. So I told you how to get the free cash flows. Remember? There are two cash flows, free cash flows to company, free cash flows to equity. So I told you that when WACC is given, we use free cash flows to company. Okay. So in this question, if you can go to the question and see that we are given discount rate, WACC. Okay. So when WACC is given, we use free cash flow to company. So the sale price of the coffee shops, which we need to find, is the present value of future free cash flows. How do you get the future free cash flows? Free cash flows to company, because WACC is given, you take revenue, deduct cash costs, deduct TAD, interest doesn't come, you get taxable profit, then pay tax. Okay. Now listen carefully. You are not given revenue here. You are not given cash costs. You are not given TAD. You are not given the interest. You are given here after tax profits. So you should start finding free cash flows from this after tax profits. Okay. So after tax profits for 4 years is given. Okay. And the after tax profits means you need to start from here, right? Because it's taxable profit. That means PBT, you pay tax. There is after tax profit, and then you can continue from here. If to find future free cash flows, you have done many questions in the classes. If revenues was given, okay, cash cost was given, TAD was given, you find through everything. But it has been observed in this question that it's starting from after tax profit. Okay, so after tax profits means it's starting from here. Okay, so just the addition of TAD, investment in NC, and investment in working capital is left. Okay, so let's start. So year 1, 2, 3, 4. Okay, so it's clearly stating that the sale price of the coffee shop would be the sum of present values, future free cash flows. So I need to find future free cash flows. It's revenue, then cash costs, then TAD, then interest, you get PBT, you pay tax. So nothing is mentioned like this. So revenue, had it been given, I would have written cash costs given, I would have written, okay, TAD, okay, nothing is given. So you need to start with the after tax profits. That's PAT. Okay, and then after tax profits, we take add back TAD, investment NC, investment working capital. Okay. Okay, and doing this would give you FCF, right? So you can start from the PAT portion. I think I have explained it carefully that why you need to start with PAT, because you are being asked the sale price of the coffee shop. It's the present value of future free cash flows. Okay, when you talk about present value of future free cash flows, you need to find free cash flows for the future. It's 1, 2, 3, 4 till year 1, 2, 3, 4. It starts from revenue, cash cost, TAD, but it's starting from PAT. So I will write PAT here. Now, what are the PAT? The PATs were, go to that question. 296, 328, 360, 388. So I will write this. 296, then 328, then 360, and then 388. Okay, you add back TAD, no information about TAD is given. Then you list investment in NC, investment in working capital. So do you think any investment in NC information is given? Yes, TAD is not given, but investment in NC is given. You can go in the question and see. See, point number 2. Capital investment in the coffee shops can be assumed to be 60 million in year 1. In the 2nd to 4th year, capital investment increased by 0.5 per dollar when increase in after-tax profits. So it's 60 million in year 1. So you can go in year 1 and write 60 million. It's a deduction, right? Okay. And from 2nd to 4th year, what it is stating? The investment from 2nd to 4th year will increase 0.5 per dollar when increase in profits. So if you see 0.5 per dollar when increase in profits, the profit is increasing from 296 to 328. 296 to 328 means profit is increasing by 32. Okay, 296 to 328 means profit is increasing by 32. When profit is increasing by 32, the investment in capital investment will increase 0.5 per dollar when increase in profits. So if profit is increasing by 32, 0.5 per dollar will mean it will increase by 16, 50%. 0.5 per dollar one means for every $1 increase in profit, it's 0.5. So for $32 increase in profits, it will increase by $16. This will become increase by 16 to 76. Okay. Then from year 2 to year 3, you see the profits increase 328 to 360, again a 32 rise. So for 32 rise, it will increase by 16, become 92. And from year 3 to year 4, the profits are increasing by 360 to 388, 28. So 0.5 per dollar one increase means it will increase by 28. So 0.5 per dollar one would mean $28, 0.5, 14. So it will become 106. Okay. For every increase in profit, you increase it by 0.5. So for 28 increase, you increase it by 40. No information about working capital is given. Okay. So you get FCF. So what is the FCF? You can sum all. Cell G8 to G11. Yeah. Okay, it's 236. So this is the future free cash flows for year 1 to 4, and it's saying after 4th year, what will happen after 4th year? Free cash flow would increase at 3.5% per year for the foreseeable future. So you can increase them by 3.5% per year. So 5 to infinity. Remember this, we did it in classes. It will increase by 3.5% per year. So 282 will increase by 3.5% per year. Okay, 291.87. Okay, these are the future free cash flows. Now, why did I need to find the future free cash flows? Because it's stated that the sale price of the coffee shops will be the sum of present value of future free cash flows. I have got the free cash flows. So the sale price is the present value of free cash flows. I have got the future free cash flows by applying my formula. The sale price is not the free cash flows, it's the present value. So for present value, I need to multiply it with the discount factor. That is 10%. Okay. So 10% discount factor at year 1 is, 0.909. Year 2 is 0.826. 0.751, 0.683, and remember 5 to infinity. You take the last discount factor. What is the last discount factor? 0.683 and divided by WACC minus G. So what is the WACC? 10%, 0.1 minus G is 3.5%, 0.035. Remember this formula? for 5 to infinity, those students who have taken classes from me, last discount factor 0.683 upon WACC minus G. Okay. You get the present value. So it's G12 into G13, and you can drag them. Okay. This is the present value of future free cash flows, and the sale price, as mentioned, is the sum of present value of future free cash flows. So I just sum the present value of future free cash flows, which is from G14 to K14. This is the sum of present value of future free cash flows. I get the sale price, that is 3883. Okay, this gives me 4 marks. If you have any questions, you can ask, you can copy. We are taking a 5-minute prayer break, and then I will resume the further requirements. Okay, in the meantime, if you have any requirements, questions, please ask me. Okay, we will meet after 5 minutes. Okay. Now, after this requirement one, which was, I think, worth 4 marks, that calculate the expected sale price of the coffee shops. The question clearly mentioned that the sale price is the sum of present value of future free cash flows. Through my format, you just got the free cash flows. Either it's starting from revenues or PATs or some mid-level. Okay. You got the free cash flows, you discounted it, you got the present value of future free cash flows. That's the sale price. Okay. Now requirement A2 is 9 marks. Calculate the impact of the sale of coffee shops on CC's balance sheet, EPS, and weighted average cost of capital forecast. Okay. So impact of sale of coffee shops. You sell the coffee shops. At the moment, you have two divisions, right? Coffee shops as well as that juice brand. So impact of sale of coffee shops on your balance sheet, on your EPS and your WACC. And remember, when you sell the coffee shops, you're only left with the juice brand division, right? So you need to prepare a forecast statement of financial position balance sheet with only juice brand, the WACC of only juice brand, and the EPS only with juice brand. Okay, so let's start. I'm first preparing the forecast statement of financial position, impact of sale of coffee shops. Okay. This exhibit 2 was related to sale price of the coffee shops. Okay. This was the balance sheet. At the moment, it's current balance sheet. I'm copying it from the question. Okay. It's now A2 time. Which states impact of sale of coffee shops on forecast SOFP. Okay, impact of sale of coffee shop on forecast SOFP. So let's start impact of sale of coffee shops on forecast statement of financial position. This was the current balance sheet. So I'm making a new balance sheet, impact of sale of coffee shops on forecast SFP. Now it starts with assets first, non-current assets, current assets, and then we get total assets. Then it has equity and liabilities, so call up share capital, then retained earnings, so you get total equity. And then it has non-current liabilities, which has 9% loan notes, then bank loans, and get total liabilities. And you get total non-current liabilities. And in this total non-current liabilities, you add current liabilities. So you get total equity and liabilities. Okay. So you have to discuss at the moment the balance sheet which was created. The balance sheet which was created through the question which was mentioned in the question. You see, this balance sheet was non-current assets, current assets, everything. And it was clearly mentioned that this is the balance sheet, including fruit juice bars and coffee shops. Now it's clearly stating that we need a forecast statement of financial position. Impact of sale of coffee shop. That means you need a forecast statement of financial position after you sell the coffee shops. Okay. So here the information is in the other information. Okay. Now, the proceeds received from the sale of coffee shops would be used to first pay off the 9% loan notes. Okay, look at point number 1. The amount you receive from sale of coffee shops, it will be first used to pay off the 9% loan notes. Okay. And the remaining amount would be invested in enhancement expenditure on non-current assets. Okay. The investment in non-current assets in the juice bars would be expected to earn a 17% pre-tax return. So this return is not a part of balance sheet. Obviously, return is profit that comes in profit and loss account. But listen this point carefully. The proceeds received from sale of coffee shops. When you sell the coffee shops, obviously you receive some proceeds. Okay. The proceeds from sale of coffee shops would be first used to pay off the 9% loan notes. You will be pay off your loan notes. Remaining amount would be invested in enhancement expenditure on non-current assets. You will also enhance your non-current assets. That means non-current assets will increase. And second point, the current net book value of the non-current assets of the coffee shops can be assumed to be 3350 million. The current net book value of non-current assets of the coffee shops is 3350 million. The profit on sale of coffee shops will be taken directly to retained earnings. Okay. So I want to tell you one thing here. Look at the first point. The proceeds received from sale of coffee shops would be used to pay off 9% loan notes. That means the proceeds received. This is the proceed received, right? 3883. This 3883 is the proceed received. This is the proceeds received, right? How much? 3883.43. This will be first used to pay off the 9% loan notes. 9% loan notes. So what is that? 1700. Okay. So you receive this proceed to pay off the loan notes. Okay. So what is the remaining amount left? Remaining amount is P20 minus P21. So the proceeds received is used to pay off the loan notes. And what is the remaining amount? It states. It states that the remaining amount that is 2183 would be The proceeds received from sale of coffee shops would be used to pay off the 9% loan notes. So I paid off the 9% loan notes of 1,700 from the sale price. Remaining amount would be invested in enhancement expenditure on non-current assets. Okay. And second point, the current net book value of non-current assets can be assumed to be 3,350 million. Now, please pay attention. I am showing here the impact on forecast statement of financial position of sale of coffee shop. Obviously, when you sell the coffee shops, please pay attention. When you sell the coffee shops, I have to work here so that you understand it properly. Now, your non-current assets currently are 6625 million, right? Your non-current assets are currently 6625 million. The net book value of coffee shops is 3350 as per point number 2. So when you sell the coffee shops, the impact would be that this 3350 would be eliminated. At the moment, your balance sheet comprises the coffee shops and juice bars, both. That's mentioned. Okay. Now, if you sell the coffee shop, you need to make a balance sheet when you sell the coffee shop. Obviously, this 6625 will get reduced by 3350 because this is the net book value of the coffee shops division. When you sell that, the net book value goes. Okay. But since you are investing this remaining amount of 2183.43 in non-current assets of juice bars, your non-current assets would grow by this 2183.43. So your new non-current asset figure is going to be this 6625 minus 3350, coffee shops gone, and you add this 2183.43 enhancement expenditure. Okay. This will become 5458, right? And another impact of this, since you paid off 9% loan, your loan notes should get removed. There are now no loan notes left. Okay. Any questions with these two adjustments which I made? You can ask on the WhatsApp group. Obviously, when you sell the coffee shop division, its non-current assets gone 3350. But the questions clearly stated that the proceeds you received are 3883. You paid off the loan notes, so loan notes gone. And the remaining was investment in enhancement expenditure non-current assets, so it got added back. Okay. Further points. I have discussed the 2 points, okay? That the proceeds received was paid off for loan notes gone. Remaining amount invested in enhancement expenditure on non-current assets. So I added the remaining amount, and current net book value of non-current assets of coffee shop got removed. Okay. So Ahmed Zubair, you are asking a question, won't go in retained earnings. So I am not yet here on retained earnings. Okay, let me come to there. And the profit on the sale of coffee shops will be taken to directly to retained earnings. So profit on sale of coffee shops will be taken to retained earnings. Okay. The figures for current assets and current liabilities can be assumed to remain same when the coffee shops are sold. So this current assets and current liabilities would remain same. So let me adjust it here. Current assets remain. Okay, so the current assets is likely to remain same. So it's same. And sorry, current assets and current liabilities will also remain same. Okay, so when your non-current assets and current assets figure is there, so you just total it to get your total assets, just G23 plus G24. This comes to 5993 as your current assets figure. Okay, so current liabilities are same, and now your non-current liabilities only have this bank loan. So this should become 1575. Okay, this should become 1575 because now there is no 9% loan. It was paid off. So 1575 and 455. So total equity and liabilities, just pay attention. This is same 1575 and 455. The overall pre-tax cost of debt is currently 8%. It will fall to 7% when 9% loan notes are redeemed. Okay. CC currently has $500 million one shares in issue. You have $500 million one shares. These are currently trading at $8 per share. This is expected to rise by 5% as a result of sale of coffee shops. When you sell the coffee shops, the share price increases by 5%. Share price increase doesn't come in this balance sheet, in statement of profit and loss, statement of balance sheet, statement of financial position. There is only capital and premium coming. Okay, so capital is still 500 million. You have not issued any new shares, so capital will still remain at 500 million. Asset beta and tax rate doesn't come in statement of financial position. So now pay attention. Since this capital is also remaining same, 500. Okay, leave it here. You can do one thing here. You have got the share capital remaining as same, 500 million. Okay. Now, please pay attention on the screen. It's 500. Non-current liabilities 1575, current liabilities 455. But total equity and liabilities must equal total assets. Assets should be equal to liabilities and capital. So it should be here 5993. Because since assets are 5993, they should also be 5993. Right? So if this is 5993, okay, total equity liabilities, okay, and you know that total non-current liabilities are 1575. Current liabilities are 455. Okay, you can deduct them. Okay, so equity should remain as 5993 less 1575 less 455. So equity figure should be 3963. Equity figure should be 3963. So 3963. Okay, and if equity figure is 3963, 500 is the share capital. So retained earnings can be found by balancing figure. So balancing figure for retained earning is 3963 minus this 500. 3463. No need to do any calculation with respect to retained earnings because you have got all the numbers and only the missing number was left of retained earnings. You found it through the balancing figure. Okay, I have prepared a balance sheet. If you have any questions, you can ask on WhatsApp group. Now, a question comes in student 9 that it asked us to take the increased profits in return earnings. No need to think over anything because you had all the figures. You just found return earnings by balancing figure. Everything has been adjusted. Let's start. Impact of sale of coffee shop on EPS. You all know the EPS formula. It's PAT less preference dividend over number of ordinary shares. Okay. So since it's asking impact on forecast EPS, you have to find EPS for the next year, right? Forecast EPS means next year. Okay. So let's start. Currently, the after-tax profits of CC, including the profits on coffee shops, can be assumed to be 658 million in year one if coffee shops are not sold. Okay. So if not sold, your profit after tax is 658 million, right? So your PAT is 658 million. It's clearly mentioned that PAT will be 658 million. If we don't sell, okay? And number of shares. We all know that currently company has 500 million shares. So there's no preference share, so no preference dividend. EPS will be PAT less preference dividend over number of ordinary shares, 658 divided by 500. This is the current EPS. Okay, if you don't sell this. Okay, but you need to pay attention that if you sell this, your profit after tax won't be 658 million. Why your profit after tax won't be 658 million? The question clearly mentions that this 658 million will be the profit if coffee shops are not sold. And coffee shops generate 296 million in year one. Okay. So your profit after tax would be working one. Your profit after tax would be firstly, this 658 million is the profit if we not sell them. This 658 would be the profit if we don't sell this division. Okay. And you're selling coffee shops. That is making a profit of 296 million. Okay. So if we just see it here, your PAT is going to be 658 minus 296, because if you are not selling this division, it's generating a profit of 658, the combined profit, if you are not selling them. And coffee division, which you are selling alone, generates 296. So if you sell this division, the coffee shop's profits would be gone. PAT would be 658 less 296, 362. Plus, selling this also means interest saved. Selling this also means interest saved. How come? Remember, you paid off the loan notes, right? You paid off 1700 worth of loan notes, which was creating an interest cost of 9%. Okay, so this interest cost won't come if you sell the coffee shops division. So this means you will save 1700 into 0.09. But this figure needs to be taken into consideration for after tax. Okay, so make it after tax. That means multiply it with 75% or do it to 1 minus 0.25. Your interest would be safe 114.75. Again, repeating, if you sell this division, the coffee shop's profits would be gone. 296 less, interest would be saved. Okay, that 1700 would save 9% because it's gone, but take it after tax. So multiply by 1 minus 0.25 or 75%. This will increase my profit. Okay, and additional return What is this additional return? Remember? The investment in the non-current assets in the juice bars will be expected to earn a 17% pre-tax return. So point number one stated that proceeds received from selling the coffee shop would be used to pay off 9% loan notes. Remaining would be invested in enhancement expenditure on non-current assets. Remember, you invested some remaining amount. That will earn 17% pre-tax return. So this will also increase in profits. So remember, you invested this remaining figure of 2183.43 above remaining amount. This will generate 17%. So you need to account for that as well. This is pre-tax. I will make it post-tax again. So 2183.43 will be generating 17% return. And again, make it after tax. 1 minus 0.25 or multiply by 75. That means your new PAT is going to be 362. That is P29, sorry, P28, plus the interest saved, P29, plus the additional return, P30, 755. And did we increase the number of shares? I think we didn't issue any shares, so number of shares are still 500 million. Now you can divide it. L40 divided by L41. You get a new PS. So it's just about reading the question carefully. Impact on EPS. So currently the PAT was 658. You sell the coffee shop, the PAT is gone. Your interest is saved 1700 into 9%, make it after tax, and you get additional return, new EPS. Okay. Any questions, please ask in the group. Okay, now for this second part, there is one last requirement. That is impact of sale on WACC. Okay. Now I find this requirement specifically of WACC very easy, because you all know that for WACC you need four things: KE, KD, ED. Okay, once you have these four things, there is no problem in finding WACC. Okay, so obviously you have made the balance sheet that after sale of copy shop, your debt is now not the both the 9% loan notes and bank loan. Your debt is only the bank loan, 1575. Okay, or you can make it B. Okay, previously there was equity, shares, debt, loan notes, and bank loan. Okay, now either you can say this is only B left, bank loan left, or you can consider a debt. Doesn't make any difference. Okay, so D is now just the bank loan, or you can write it B as well. Okay, because one debt is gone. And secondly, you had this KD, in which the question has stated that overall pre-tax cost of debt is 8%. It can be assumed to fall to 7% when the loan notes are redeemed. So now cost of debt is also given. It has become 7%. Okay. E market value of equity, it's the number of shares into current share price. So you can check number of shares are still 500 million. But the share price is now not 8. It will increase by 5%, remember? Okay, so 8.4. $4,200. Currently has 500 million shares. They are trading at 8 per share. This is expected to rise by 5%. So you will increase it by 5%, 8.4. Okay. Now, asset beta is 0.7, tax is 25%, and risk rate 4%, market return 11%. Okay. So impact on WACC, you need K, KD, E, and D. So after the sale of coffee shops, that is only 1575. KD has fallen to 7%. E is number of shares, 500 into share price. K is left. You know the formula of K. RF plus RM minus RF into beta equity. Okay. So KE working I'm doing here. Risk-free rate is, I think, given 4%, market return 11%. RM is 11%. Now you need a beta equity. It's not a problem. You have beta asset and you know the equation of beta asset, right? It's given in the exams. Beta asset is equals to beta equity into E over E plus D plus beta debt into D over E plus D. Okay, you know this equation that beta asset is equals to beta equity into E over E plus D 1 minus D, right? Plus beta debt into D over E plus D, but beta debt is not here. So you have beta asset 0.7 7, I think, right? You have beta asset 0.7. Yeah. You need a beta equity. So beta equity can be found. I'm sorry, my pen is not working today. So what is E after sale? It's 40, 200, over again 40, 200 minus what is D? 1, 5, 7, 5, and bracket 1 minus 0.25. 25% or 1 minus 0.25. Okay. So if I do this, this will make 1575 multiplied by 1 minus 0.25. Okay. Sorry, it's plus 4200. 0.78, and I take it on that side, 0.7 divided by 0.78. This will make it 0.897 as your beta equity. Okay, and when I have the RF, RM minus RF beta equity, I can do this KE working. RF is 4%. That is 4% plus RM minus RF, 11% minus 4% to beta equity. That is 0.897. 10.27%. Okay. So I have this 10% approximately. This will help me find a WACC. KE, that's G48 into E over E plus D. That's G50 over the sum of both 200, 5775. This is the first bracket. Plus KD1 minus T, it's not 7%. After tax is going to be 5.25%. Into D, G51 divided by 5775. So your WACC is going to be approximately 8.9%. Or 9%. Okay, so we have done the requirement A as well as requirement B. The impact of WACC was very simple because you had KD given after the sale, you had debt given, equity, number of shares into share price, K, RF plus RM minus RF, beta equity, beta asset was given, so I found beta equity. Okay, so my calculation requirements are over. Now we will move towards the theoretical requirements. Still, if you have any queries, you can ask me. Mahat, please read the question carefully. It's clearly mentioned, as I show on the screen, the overall pre-tax cost of it is 8%. So how can you say that it's 7% post-tax? Okay, now I think we should refer to the other parts of the question. This 7 marks seems to be a very lucky and very mark scoring requirement if you handle it properly. Evaluate the arguments for and against the decision to sell the coffee shop. You need to write some arguments in favor of selling and against of selling. Okay, don't write generalized one. Whenever you write generalized one, make sure you link it with the scenario. Now, you must read the examiner answer also. This is, I am writing in bold that must read examiner answers. But just for knowledge, but at the moment, you can just discuss with me that what can be the arguments in favor and what can be the arguments against the sale. If we gather 7 points, that will be more than enough. Okay. Arguments in favor. Okay. Number 1, immediate cash generation. Okay. This is an advantage in favor that you immediately generate cash. Okay. Lower WACC, because when you sell, you get cash and you pay off your debt. So when you pay off your debt, obviously your weighted average cost of capital goes down. So immediate cash generation can be an advantage, and lower WACC can be an advantage. You need to elaborate them. I'm just writing the points. Increased EPS. Your earning per share is rising from 1.316 to 1.5. Okay. You may not get that offer again because you know that the competition is increasing in this market, in the coffee market. So when competition is increasing, since the last 2 years, your profit is also falling. Someone has approached you to buy. They may give a good offer now, but you may not get a good offer later. So it's better to exit now. This can also be an argument in favor of selling. Expansion. Okay, you get expansion in juice bars area, and you believe that it offers more good prospects. At the moment, it was being funded through surpluses of coffee business, but now coffee business is not generating surplus. So where will the cash come from for expansion? This sale may produce a favorable argument in favor that you get immediate money for expansion. Okay. Against. Dependency on one business. At the moment, you were dependent on 2 businesses. Your income was coming from 2 businesses, but now you will only be dependent on 1 business. This can create a problem because lack of diversification. Okay. Shareholders prefer diversification. Okay. When you avoid diversification, you only get dependent on 1 business. This can create a problem for you. High business risk. Coffee business has a comparatively lower business risk. Why? It's just about having a good taste and quality. But this juice bar business, which you have already branded them, salads, juice drinks, you have to maintain the proper combination, proper taste, proper features. More than 1 chefs increases business risk. Not good history of this business. This business doesn't have a good history. This was being just run by the surpluses generated from coffee business. It never generated its own surplus. So this doesn't have good history, and still you are going for that. This can be arguments against. So if you just elaborate these points in 2, 2, 3 lines, one point per mark, I've got you 8 points, 8 points, which easily secure you 7 marks. You don't need to write 8 points. You just need to write 7 points. Okay. Okay, let's move to the last requirement now. Discuss the advantages and disadvantages of the suggestion made by NED. Now, the NED's information was only in exhibit number 1. Last paragraph, one of the non-executive directors has suggested an alternative arrangement. Under this arrangement, coffee shops would be run by a separate company. CC would hold a majority of shares in this company, but offer a minority shares on the stock market. Okay, don't sell completely. Hold major shares yourself for the coffee shops and offer minority shares on the stock market. Okay, so what are the advantages and disadvantages of suggestions made by non-executive director? You just need 5 points. So you can write the points like in the first instance, when we talk about advantages. Diversification still present, right? This can be the first advantage, that you still have diversification left because you are still holding the majority shares yourself and offering minority shares on the stock market. So an advantage of non-executive director suggestion, it's asking advantages and the disadvantages of a suggestion. Diversification still present. Control with us. Obviously, when you sell, the control goes. But now if you're keeping this, the control is with you. And more clarity on performance. Since it would be run by another company, you would be clearly knowing that what is the performance of coffee shops and what is the performance of juice bars division, because we are running juice bars, they are running coffee shops. More clarity on performance. Okay, because when you run via division, the head office costs get apportioned jointly, so you don't get a crystal clear picture. But since it's run by another company, more clarity on performance. Okay, disadvantages. Less cash flow generated because you sell partially. Less cash flow generated. Won't be able to pay off debt. Won't be able to expand. These can be the drawbacks. Okay, elaborate in two lines, you get 1 mark. Okay, so we have done a complete 25-mark question. For the theoretical parts, to read the examiner answer. Okay, we are now ending the class for today. Take care.